So today, as I mentioned, we're going to be talking about rebuilding market structure for the next cycle. This year's been an interesting one where everyone's been excited through Q1 and then sort of hesitant and waiting for some market catalysts to come through. So today we're joined by some esteemed panelists. We've got Max from PV01, Josh Lim from Arbelos, and Darryl from Tangent. So I'm going to quickly pass across to our panelists to introduce themselves very quickly. Max, if you want to start, Josh, and then Darryl.
A quick intro, yeah?
Quick intro if you can, yeah, please.
I started my career at Goldman, where I was an interest rates trader, and I left in 2015 to start B2C2, which became one of the main dealers in crypto. And a year ago, I started a new company called PV01 that is in the RWA space and focuses on putting bonds, starting with US Treasuries, on the blockchain.
Hey everyone, my name is Joshua Lim. Like Max, I started my career at Goldman in traditional finance and moved into crypto. I've been at a couple of large trading shops like Galaxy and Genesis, and most recently, also in the last bear market, started a firm called Arbelos Markets. We're focused on derivatives, market making, liquidity provision. We trade a lot bilaterally, OTC with counterparties, and then we do a lot of on-exchange block liquidity, mostly on Deribit, Binance, OKX.
All right, and I think all of us here from a traditional finance background. I also used to come from JP Morgan, was on the investment banking side of things, and then hopped over to crypto and joined Defiance as they were starting out Defiance Capital, which was Asia's first DeFi-focused fund. And again, in the last bear market, also started my own company called Tangent. We're now an evergreen crypto prop fund where we invest in pre-seed and seed angel deals, as well as discretionarily taking positions on the liquid markets as well.
Awesome. Thank you, guys. So moving straight into things, if you're thinking about market cycles, and you mentioned the last bear market, we're thinking about the next bull market. Of course, everyone here is hopeful and excited for 2025. In order to think about the future, though, we have to think about the past and understand mistakes that were made and problems that were exposed in the last downturn, and how do we rebuild those for the future. So the first question I've got for you guys is, what is something from the last cycle that we should leave behind, and what is something that we should take forward with us into the next cycle as we think about building? Max, do you want to open up?
The difference between secured and unsecured credit exposures. I think people tend to conflate the two. And we were used to such high rates, even secured rates in crypto, on account of simply the futures trading at such a huge premium. At some stage, you could get a 20% roughly risk-free rate. And so people just were used to that and didn't realize that when Celsius came in and was willing to borrow at 23%, you thought, oh yeah, I'm getting like a 3% pickup on top of the risk-free strategy. But the 23% didn't compensate for the extra credit risk you took to Celsius. And I think everything's been a bit conflated. We're in a better space now because futures trade much more in line to where the risk-free real-world interest rates are, around 5%. And so it's still a bit of a premium for exchange issues, operational risk, that kind of stuff, liquidations. But it's not that much. And I think that now people are really understanding that if you're getting a 50% interest rate, 15, then it's got to be you're taking some additional risk, which was it was very blurred in the last cycle.
Yeah, so I think you're pointing out that we've become better at evaluating where counterparty and credit risk sits as we move forward. Josh, anything to add? What do we want to leave behind and what do we want to take with us?
Yeah, I think the most salient feature of the last cycle was that all the types of risks that different firms were taking, whether they were like lending firms or hedge funds or even corporates in the space and foundations, everyone had basically just market exposure in some format. And it turned out like if you had a basis trade or if you were lending to counterparties or if you were running a market making business whose revenues were largely correlated to like tokens going up, right? It was all just generally market beta. The lack of transparency around that basically made it such that it was very difficult for many firms in the space to evaluate counterparty risk. And the fact that ultimately the kind of like web of connectivity of different firms in the space all led to every firm having the same risk to the same set of counterparties, right? So I think for us and what we were trying to do when we started Arbelos is just start a new form of business model that was based on transparency. So allowing counterparties to have some visibility into our balance sheet and sort of our financial health in real time. And that helps us to sort of win business, but also present ourselves as a credible counterparty for bilateral trading activity. So
Yeah, I think it's both parties are trying to give everyone the tools they need to evaluate the risks appropriately and generate yield in the correct ways so that you're not taking risks you're not aware of and there's no contagion to other parties. Darryl, when you're looking at companies to invest in and teams to invest in, how important is it to think about these sort of concepts? Have they looked at those things as well?
It's pretty different, I think, at the pre-seed stage. We're not really that advanced into most of these on-chain transactions yet. But I will say that I think something that definitely needed to go was the lack of due diligence that under-collateralized lending desks did with their clients. I mean, there was that famous 3 Auros sort of balance sheet that was circulated around back in 2022, where one of the co-founders basically just signed off and said, he had like X billion dollars worth of capital or collateral, and then he just said, yes, I have it. And then they took it at face value and just lent him the money. Right? I think that obviously has changed quite a bit. Us as a firm, when we've onboarded with different lending desks as well, now the due diligence is significantly more complicated or more sophisticated, which is, I think, is a good thing. So at least you don't have these kind of sort of traps that are laying out when markets are in free fall. I think one thing that I do wish that we bring back is the FTX type of cross collateral that allowed a lot of traders to use different sorts of assets as collateral for their positions. Now, I don't think you get as much flexibility. I know Binance offers some of that, but most of it is still either USDT collateralized or BTC or ETH. And I think one of the perks of trading on FTX in the last cycle was really having that ease of fluidity between collateral types that you could just use and just continuously keep trading.
Yeah, so that's interesting because you've essentially identified that standards have raised, like the due diligence process is higher, as it should be, increases friction, cross-collateralization's harder to do, so you can trade less or less efficiently. So I guess that's part of the rebuilding process, right? We have to identify the problem, raise the standards, and then work out ways that we can be more efficient with it. And I guess that leads me into sort of question 2. As we move into the building blocks for the future, how important is new capital or liquidity coming into the system? This has been a year where we've talked a lot about institutional capital flow from ETF approvals. How important is it to have that new money in the system to, I guess, keep things flush and moving when frictions can be higher because of better standards? Josh, do you want to start with that one?
Yeah, I mean, I think we all realize like we're in crypto because we believe this asset class can be much bigger than it is today, right? And even though Bitcoin in particular feels like it's near all-time highs from a dollar perspective and also from like a Bitcoin dominance perspective, it does feel in many ways like a bear market for most people in the space. So like why is that happening, right? So I think one of the big answers to that is that the market structure has changed dramatically where new capital comes into these ETF products, and it's largely institutional capital that stays locked into these products and doesn't really recirculate or recycle into like higher risk assets within the ecosystem. And last cycle, obviously, a lot of that rotation happened, and it created this like hot ball of money that would circulate and kind of prop up altcoin prices and things like that. So I mean, that's like one very fundamental change that's happened in market structure this cycle versus last cycle. I think the way we deal with that is like we basically construct the same set of financial infrastructure that people demand in other asset classes, like commodities, like for instance, like gold markets or oil markets, like basically other markets that require derivatives trading and clearing and settlements, all of these pipes that you need to attract more institutional participation, because that's actually where all the money is going. It's less focused on retail trading and leverage and that sort of thing. So unfortunately, that's kind of like the trend in the market today. Maybe not unfortunately, maybe that's just a sign of a maturing asset class, but yeah, that's how we're thinking about it.
Yeah, sure. And I think we're between a rock and a hard place because traditional capital doesn't really want to touch crypto because it's risk they don't really control, right, or understand. And then there's lots of capital in crypto, but it's also capital that doesn't really understand how to do things the right way. And there's some concepts that come naturally to Josh and I, but things like asset liability management, no one has got any clue in crypto how that's supposed to be done. And so you end up with people who, let's say, there's a ton of Bitcoin capital in the market, and people are willing to lend it and do stuff with it. The thing is that if you understand how to run a financial firm properly, you've got no use for that Bitcoin capital. That's not what you need, right? And so there's too much Bitcoin capital that no one needs. There's not enough fiat type, stablecoin type capital in the market. And that would naturally come from TradFi, but TradFi is just not that interested. And so we really need to find some sort of fit there. But
Sorry to interrupt, do you think they're not interested, or do you think that the pipes that Josh mentioned haven't been built yet to let them in?
I think even if the pipes existed completely, first of all, crypto would need to adopt them, and we found that to be quite difficult. I can't count how many startups have failed who tried to do, PvP settlement. I mean, it's been years that we've talked about that. So lots of those things culturally are more difficult for crypto to accept, and even if they were accepted tomorrow, I think on the TradFi side, they need to get comfortable that we're actually doing things the right way. But things are changing a little bit. One of the big problems we had in the previous cycle is that all the lending firms were working with one another, but because we had conglomerates, FTX was an exchange, a market maker, Celsius was a retail business, a lending desk. They were all, in some sense, competing with one another. And no one wanted to open a kimono to do proper due diligence. And I think one thing that we're going to see emerge this cycle, and my firm is also trying to do something like that, is to have firms that are advisory firms that sit in between the lenders and the borrowers and conduct a type of due diligence that doesn't seep through the market and that remains private, right? You can have an underwriter of credit risk that's not one of your competitors. And if you do that, then you're going to be happier to share your financial and your operating procedures, and the underwriter is going to be, sticking their neck out to vouch for you, which is something that, when Alameda was borrowing from Genesis, they didn't want to share that kind of stuff.
So you're removing that competitive secrecy between the firms by having trusted middlemen, intermediaries that act as transparency, source of truth.
Fiduciaries.
It's important that you have that. That's something that exists in TradFi, right? And if we want to have a new financial system, we've got to take the good parts from TradFi and move them into our space and have it be there. That's definitely for sure. So moving on, if we were to assume that we move into the bull market, hopefully tonight when the FOMC decides to act, if we move into the next cycle and the bull market kicks off, what are sort of the ways that you guys are going to navigate that? Darryl, do you want to start with sort of how are you going to identify who are going to be the winners in the next phase as you look to invest capital into seed projects and earlier, or even projects you may have invested in?
Yeah, no, I think the winners are already slowly showing their hand in terms of the technological superiority, the sort of the depth of the ecosystem that is being built on different L1s. Solana definitely has really come into light this cycle as the most active or most vibrant L1 today. I think if capital does come in and you do get Bitcoin all-time highs again, I think that trend is very likely going to sustain, and you probably get competitors of Solana that attempt to do what they're doing, and some are touting a couple of names out there like Sui, Aptos, for example, as alternatives to Solana. That definitely is something that we're looking at. On a venture basis, we try and actually stay away from investing in L1s going forward. I think the time for investing in L1s is past already, and we're looking at specific applications. More so in the DePIN vertical, the SocialFi vertical, and selectly still DeFi as well. So that's general. But a lot of what we do as well is we adopt a liquid trading strategy to markets, and so typically we will be looking at BTC as the main vehicle to ride the next bull market, simply because it has greatest, ease of access from institutions. And I think the most latent bid still bids BTC, even in this cycle. It's very clear, it's very evident as a function of BTC dominance. I don't think that's going to change. And only when we're pretty confident that, FOMO capital has come, will we start looking out towards the lower market capitalized coins for outsized returns.
Got it. And you touched a little bit on BTC dominance and most accessible pair, probably the most liquid pair in the world. Josh, how important is liquidity for your business? Arbelos, you obviously market make options is a large part of what you do. How important is it not just that you're able to provide liquidity, but there is other market making liquidity in there for your success?
Well, yeah, I mean, no market maker can really exist in a vacuum, right? Kind of, we all require like an active ecosystem of market participants, end users that are using derivatives to hedge their books or take very, sort of like nuanced, leveraged views on catalysts, or they're sort of like trying to get yield or something like that by selling vol. So I think that's there's a lot of different players that we're seeing coming into crypto in this cycle that haven't been active in the last cycles. A lot of them have to do with like more institutional users, right? Like firms that are using options to generate yield for structured products, or corporate balance sheets that are hedging their exposures or getting leverage to crypto in certain ways. And then there's a whole sort of like class of macro hedge funds that started to get active last cycle, but I think now they're kind of like more dominating the flows these days relative to the more crypto native hedge funds out there. But I think, like, to go back to your previous question, just around like investing theses and narratives, like I think it's very clear now in this cycle that there's this like divergence between Bitcoin as this store of value, like hard money asset, versus other things in crypto, and I think that trend is going to continue. I think ETH has sort of like not lost its way, but it's sort of been diluted as this asset that has some hard money properties because of just the diversity of like layer 2s and other applications that have tokens on it, like governance tokens, and it just sort of like effectively dilutes ETH, right? It becomes effectively inflationary, even though you could argue it's deflationary with post-merge. But yeah, I think Bitcoin kind of takes the crown on that, and it's like very hard to dethrone it. And I think that's why you have all this inflow into the Bitcoin ETF, for instance, and like much less enthusiasm for ETH, right? Yeah.
Now, for an answer to that question, the winners and the losers. I think what we need this cycle is, as before, incremental improvements, solving little problems that we face. Josh, you're proper OG. You remember we had Bitcoin back in the day, multi-sig on Bitcoin. That was solved. Then we used that. Ethereum came around, and then boom, multi-sig on Ethereum is completely different. Then we're stuck with multi-sig system for Bitcoin and not having that on Ethereum. Then what happened? Fireblocks came out with MPC, completely solved the problem of multi-sig, irrespective of the chain you're looking at. That was a game changer. So that was great incremental innovation. You take other businesses that have tried to fix too big of a problem, ended up being over-engineered. Look at RWAs on the private credit side. You're taking assets from the real world, not US treasuries, more complex stuff. I think one of the projects was doing lending in Africa. You bring that to the blockchain, people buy into that stuff because the rates look good, but in reality, you're suffering from the adverse selection of the bad stuff that doesn't get financed in TradFi coming onto the blockchain. So
yeah, it's that chasing the yield problem. You don't know the risks you're actually taking. You just see the headline figure and chase the yield.
Bringing treasuries on chain, totally necessary, great. Bringing private credit on chain, I'm not convinced yet. And in fact, if we don't have enough capital in our ecosystem, we don't want it to go to private stuff outside of crypto.
For sure. I think to expand on your point, it's like basically all of DeFi is like asking retail users to be marginal price setters on risk that they don't fully understand, right? It's sort of like,
and that's destined to cause problems again and again. And when we talk about rebuilding market structure, we cannot do it the same way that we did before, because you have to learn the lessons and, as you say, iterate, improve, bring certain things on chain or into crypto and leave other things out, for now at least, until we can come up with innovative solutions that will make it safe and priceable by retail, or at least understandable by the participants of the market. So I did promise everyone we were going to keep this short so you can go have a drink afterwards. Coming up in the last section, we talked about where we made mistakes, where we think we need to improve. We've talked about sort of navigating what a bull market would look like and where we think the winners and losers might be. I guess the sort of last thing I wanted to touch on is, where do you guys see the catalyst to kick this off? I joked before the FOMC tonight, but if it's not tonight, then maybe it's later in the year or early next year. Darryl, do you want to start and let us know what you're most hopeful about for the catalysts for the next bull run?
Yeah, I think the two North Stars, or the North Star we look at that dictates how aggressive we are positioned, at least on a very high time frame, is obviously number one, the elections. Trump wins, very likely DeFi regulation eases somewhat. You stop getting, Wells notices being sent everywhere. Hopefully Gary Gensler goes away. You put in place someone else that is a bit more warm towards crypto and DeFi. I think that is pretty straightforward. I think it's a lot more, I wouldn't say that it's an absolute doomsday scenario if Kamala gets elected, but I think things become significantly murkier in terms of the timelines of when, if or when, regulatory pressures ease at least from the US. The second thing that we look at is obviously easing liquidity. As we said, tonight's going to be a pretty important night for that. And I think in the next 6 to 12 months, we're going to see whether the Fed has been too late in terms of cutting rates or on time. And historically, I think when it will only be obvious in hindsight, and so you kind of have to take a forward stance in terms of estimating if the Fed is too early or not by making judgment calls earlier. Right now, we are looking for tonight as really the first signal to see what happens for the next 6 to 12 months. But yeah, it's really a coin toss right now, I think.
Max?
I have a spicy take.
7 minutes. You've only got 7 minutes for the spicy take.
It's going to be very short. You also remember, around 2015, one of the big catalysts for Bitcoin adoption was Chinese yuan outflows. Yeah, capital controls. Whether we like it or not, it was a big catalyst. If you go back even before that, we had yet other stuff that was a catalyst for crypto adoption. I think one contributor to the next wave of adoption might be, in the developed world, there's lots of countries that have real balance sheet problems, real public finance problems. And I think we're going to look at the wave of adoption potentially on the back of tax avoidance. Because it's much easier to move money around when it's in the form of crypto. And our traditional financial ecosystem is not as free as it used to be. And you remember back in year around 2015, how difficult it was to get banking relationships. That stuff has improved a little bit, but kind of at the margin in reality. But for individuals, actually, it remains difficult as soon as you do something that's outside of the beaten path. If you're a big crypto institution now, access to banking is a little bit better. But if you're an individual, the market, the financial ecosystem has really gotten worse. And I take an example, not that I'm supportive of their cause or anything like that, but back during COVID times in Canada, the truckers, they got their bank accounts seized by the government because they disagreed with their message. And this stuff, I think, is going to leave a mark, especially in a context where the state is going to have to go after the assets of its citizens.
I mean, if you look at why Bitcoin came about, it was a reaction to devaluing money by the Fed and everyone else printing cash constantly. So what you've clearly identified is if the authorities or the centralized powers continue to repeat the same things again and again, the reaction will be for people to find another way. I do worry, though, that if that were to happen, does regulation have to grab a tighter hold? Because tax avoidance is not something that centralized powers really support.
Not to be confused with tax evasion, though.
No, true. Tax reduction, I guess you can probably call it. That is a spicy take. Very interesting. Josh?
Yeah, I mean, I generally agree. It's like we're in this part of the cycle where it's like very hard to stay positive about crypto sometimes, right? And like the big picture is always the same, right? The big picture is like this is a limited supply. For better or worse, like most people now think of it as like a currency. Like people are willing to store value in it. So you have to kind of believe in that long-term thesis. Otherwise, like, why are we in this space? But if you do believe in it, then like the long-term view is it has to be much bigger than it is today. And that hasn't really changed. The ups and downs, like day to day, whether it's like because Harris wins the election or because the Fed is, hiking and tightening or whatever, like those will cause market cycles in the short run, but in the long run, it's just an asset that people want to hold. That's a non-sovereign store of value, right? That's always the
the key to go back to. I mean, I think through this discussion, we've sort of identified that we have done some rebuilding. There's been some iteration on bringing certain things on chain. There's been improvements. Mistakes were definitely made in the last cycle and led to some of the pain that we saw. I certainly have a lot of hope for 2025 and the end of this year even. As you say, short-term catalyst, but I think we have the building blocks to move forward. I'm just going to pass it back to you guys. Is there any last thoughts you want to share with the audience here, or I can give them a 2-3 minute early mark for a drink?
Very quickly, I think the RWA market has to be 10x the size that it is now. It's actually not a good sign that it's only around $2 billion. It should be 20. That's a problem.
We've got a 3 trillion from the audience here, so. Josh, Darryl, any final thoughts before we close up?
Yeah, I mean, I guess as we're just talking about things that are interesting, like I think there's a lot more that needs to happen on chain in terms of just like trading activity, different types of trading venues, like derivatives in particular. I think we see there's like a reluctance from institutional users to migrate activity on chain because there's compliance processes and there's risk management processes that require them to like vet all these marketplaces that probably just launched like a year ago, and most of the venues they trade on have existed for like 20 years. So I think that's going to happen gradually and over time, but I think that will open up a lot more activity for crypto and more venues. Like basically, it'll create more stablecoin adoption. It'll create more reason to hold like crypto native collateral to collateralize all these derivative trades. Like we see it as a potential growth area for us, in terms of just growing our counterparty activities in a way that maybe like banks and other major TradFi institutions aren't going to be able to support day one. Yeah.
Definitely. Okay. Darryl, final thoughts? Any closing?
Yeah. No, I think I think there's one party or one stakeholder this cycle that still needs to step up, and I really think it's actually decentralized exchanges. I don't think they've done, well, at least with what they've been doing recently, I think it raises a lot of eyebrows, not in the right way, that can imply that a lot of things are going on behind the scenes, which is not the healthiest look for the industry. So I think the onus is on them, given that they are the most profitable stakeholders in crypto, probably, where they have the most to gain, that they should, as role models and as to prolong the longevity of the entire ecosystem, keep things above water.
Fair enough. It feels like there's still work to be done, but some exciting times ahead. I'd like to take the chance to thank you, Max. Thank you, Josh. Thank you, Darryl, for sharing your thoughts with everyone. And thank you, everyone, for sticking around till late in the day. And I hope everyone has a great evening tonight.